Due to Dodd-Frank, our banking system is strong. Our regulators avoided a crisis by quick action this month. But the solution was not free. Some $22 billion of special assessments will be imposed on banks. That will lead to lower rates on certificates of deposit, perhaps 0.25%, perhaps 1/8%. And our entire economy has been hurt. It's been rattled by what happened this month. Our bank regulatory system has some real flaws. It's an undemocratic system in which FASB writes the accounting rules and doesn't even claim to be part of a democratic government. The Federal Reserve Board's regional banks, it's not one person, one vote, it's one bank, one vote. The bankers vote on who's on the regional board, and the bankers of my state elected the CEO of Silicon Valley Bank. Banks get to pick their regulators, state or federal, holding company or no holding company, Fed or OTC. They can use regulatory arbitrage, and every regulatory agency knows that if it gets a reputation of being too tough, the banks can flee and go to one of their regulatory competitors. Our accounting system for banks is absolutely perverse. If you make a Main Street loan, you're penalized under the CECL system, and you will always list that loan on your balance sheet as being worth less than you paid for the note. If you instead go to Wall Street and buy long-term bonds, you are rewarded. If the bond goes up in value, you can sell it or classify it as available for sale and recognize a profit and justify a bonus. If the bond goes down in value, you can hide it by listing it as held for maturity and list it at the original purchase price on your balance sheet, even though you know it's worth 20 or 30% less. The crypto billionaires fanned the flames because they understood that if they can besmirch our banking and dollar system, crypto goes up, and they've made tens of billions of dollars. Silicon Valley Bank could have saved itself in 2022 by hedging its risk or selling its long-term bonds, but they knew that would cut profits and bonuses. They decided to take the risk, and here we are. And of course, our clawback provisions are inadequate. There's $600 billion of unrecognized losses on the balance sheets of American banks. That needs to be juxtaposed with the $2.2 trillion of capital American banks have. So we're overstating the capital of our banking system by perhaps a quarter. Mr. Barr, particularly watched your Senate testimony in which you basically said it was bank mismanagement for them to ignore the good advice your people gave them. It is also misregulation to let banks ignore that advice. You are not running a consulting operation. You are running a regulatory operation who can force banks to follow that advice. And interest rates go up, interest rates go down. Certainly the Fed in auditing banks ought to know that, especially when this is not a 100-year event. Interest rates go up, interest rates go down. I mean, 2023 has its peculiarities, but it's particularly ironic. It's the Fed that's raising the interest rates, and then the Fed that's not examining banks to see if they can survive if interest rates go up. The concern we all have is, are there other banks that could go under because they invested in long-term bonds that aren't worth as much as they paid for them? So I'll ask Mr. Gunberg and perhaps Mr. Barr, are there any banks out there, and roughly how many, that have capital of under 5% if you subtract from their stated capital their unhedged, unrealized losses on long-term debt?
Congressman, that's a fair question and a factual question. If I may, let us get back to you on that. We'll get the numbers and share them with you very quickly.
And please don't give me the names. Mr. Barr, do you have any other answer?
No, sir.
Mr. Gunberg, I know that you're going to be giving us a report about possibly expanding FDIC insurance this spring. I look forward to it, and I hope that you would consider $3 million of coverage, but only of non-interest-bearing accounts. because when a bank is used as a utility for a checking account, we need that coverage. If people are making investments, we ought to be a little bit more careful, and I'll yield back.
We'll now go to